Hey guys, this is your host Nitin Binhani, and a very warm welcome to my startup podcast channel Jazair Audio, where we share real stories with real learnings.
In today's podcast, we are covering Tally, a once promising San Francisco fintech startup that raised a whopping $172 million, helped thousands of people pay off over $2 billion in debt, and still shut down in August 2024. This is yet another stark reminder of the unpredictable nature of the startup ecosystem. So, what went wrong, and how you, as a founder, can avoid landing in the same situation? Let's unpack the story into 4 parts. Part 1. The rise of Tally. Tally was launched in 2015, founded by Jason Brown, with a mission born out of personal pain, helping consumers escape the crushing burden of credit card debt. The idea was to use automation and smart financial coaching to manage debt more efficiently, pay off high-interest cards first, get notified on payments, and most importantly, help users develop healthier financial habits. The pain was real, and Tally stormed big, positioning itself as a financial partner, helping users take better or informed decisions. They had market fit, capital, momentum, and a real social impact. Tally raised a whopping $172 million in funding from prominent VCs like Andreessen Horowitz, Kleiner Perkins, Sway Ventures, and an Israeli insurer, Menorah Miftachim. By 2021, it touched a valuation of $855 million. But as it's often said, the startup journey is a marathon in a hurricane. You've got to be fast or agile and adaptable. Part 2. The downturn. Many factors played a role in Tally's downfall. Let's cover them one by one. A. Macro environment. In 2021, the capital or funding was available cheap, the VC money was flying, and fintech was the hottest sector on the block. And, like many startups, Tally too heavily relied on consistent fundraising to power its operations. Fast forward to 2024, with rising interest rates, borrowing became more expensive and VCs became more cautious. The global fintech funding had significantly dropped from $210 billion in 2021 to just under $16 billion in the first half of 2024. Tally's bread and butter users were now carrying more expensive debt, and its own cost of capital was ballooning. All in all, Tally struggled to maintain financial stability. B. The pivot. In April 2024, Tally announced it was moving from a direct-to-consumer (D2C) model to a B2B credit card debt management platform. This was an attempt to adapt to declining funding and increasing investor expectations for faster growth. The idea was to license its technology to companies who could offer it to their customers. They even announced a large launching partner, but this wasn't enough to overcome operational challenges and capital constraints. Besides, one of Tally's banking partners, Cross River Bank, was under regulatory scrutiny, adding yet another layer of instability to a fragile situation. C. Competition. The fintech space is highly competitive, with new entrants constantly emerging. Tally faced immense pressure from competitors who offered similar services with better customer experiences, lower costs, and more innovative features. D. Investor pressure. With several high-profile investors on board, Tally must have been under immense pressure to deliver swift and strong returns. Often, this leads to aggressive growth strategies or risky pivots that might have caused strategic misalignments. Failing to meet investors' expectations usually leads to funding challenges. Ultimately, the inability to secure sufficient funding to support its operations, coupled with a highly competitive and volatile fintech landscape, along with a strategic misstep, forced Tally to shut down. Part 3. Cracks beneath the surface. Let's now talk about the internal issues faced by Tally. A. Product market fit. Tally's mission to help consumers manage debt was undoubtedly noble and important. However, oftentimes the idea doesn't resonate strongly enough with the target audience, or simply fails to differentiate itself in a crowded fintech space. Lack of product market fit caused Tally's growth to remain stagnant, and customer acquisition costs kept on increasing. B. Customer service challenges. Reports of customer complaints began to surface in late 2023, with dozens of users claiming Tally had stopped delivering on its promised payments and raised interest rates unexpectedly. For a fintech company, trust is currency. A breakdown in customer service can quickly erode that trust and lead to reputational damage that's hard to recover from. If users are dissatisfied or feel betrayed, they don't just leave the startup, they shout on the internet warning others. C. Excess hiring and leadership challenges. In July 2024, an honest review posted on Glassdoor highlighted that insurmountable tech debt, poor execution, and leadership challenges had diminished Tally's former glory, and that it had become a sinking ship. Overhiring during COVID was another self-inflicted wound. When revenue didn't match expectations, Tally laid off 40% of staff in multiple rounds, leading to low morale, lower credibility, and heavy burn in the process. By July 2024, insiders were already predicting a shutdown. There were attempts to sell the company to survive and cover current employee severances, but no one bought, as the success seemed unlikely given the challenging market conditions. Part 4. The Shutdown. In August 2024, Tally officially shut down. Founder Jason Brown wrote a heartfelt letter shared on LinkedIn, thanking the team, the users, and the investors. After nearly a decade, billions in debt paid off, with thousands of lives impacted, Tally was no more, Jason wrote. He emphasized that while Tally is gone, people still need better tools to manage debt, and maybe someone else will pick up the baton. Essentially, Tally didn't fail because it wasn't solving a real problem. It failed because it couldn't execute sustainably in a changing world. Finally, lessons for founders. Here are the 6 key lessons every founder can learn from Tally's failure. 1. Product market fit is not a one-time achievement. What worked in 2015 may not work in 2024 or beyond. Keep testing, evolving, or pivoting, and talk to your users regularly. 2. Don't pivot without proof. A pivot should be a strategy, not a reaction. Validate the pivot first before going all out on it. 3. Building with the downturn in mind. Raising during bull markets is easy. Building for bear markets or bootstrapping is where resilience lives. 4. Internal culture matters more than you think. Too much debt, poor leadership, and broken morale or culture will eat up even the best ideas from the inside out. 5. Trust is everything. Especially in the fintech space, the users trusted Tally with their finances. Once that trust is broken, recovery becomes impossible. 6. Capital isn't equal to success. $172 million funding, of course, is a lot of money, but without consistent execution and sustainable growth, it's just a runway. And runways always seem closer than anticipated. Tally's story underscores the reality that even well-funded, seemingly successful startups are not immune to failure. It's a reminder that the startup journey is fraught with risks, and success is never guaranteed, no matter how much capital you've raised or how long you've been in the game. Folks, that's it for today. Thanks for tuning in. Please like, comment, and subscribe to the channel. Join us next time as we continue exploring the dynamic world of startups and the valuable lessons from their journeys.